Hello and welcome to Moneycontrol. You've tuned into IPO Watch and I'm your host Nickey Mirchandani. Today we are here to talk about Juniper Hotels, a luxury hotel developer operating Hyatt properties in India, is all set to launch the initial public offering on Feb 21st. The issue is expected to close on Feb 23 and the price band for this issue is fixed between 342 to 360 per share. It's a book build issue and the company intends to raise 1,800 crore. But to know more about the financials, strategy, outlook, we're being joined by Arun Kumar Saraf, who is the CMD, and Varun Saraf, who is the CEO of the company. Well, afternoon then, gentlemen.
Good afternoon, Nickey ji. Thank you for having us on your show.
Pleasure is all ours, like I always say, but let's start off with the basics. First, what's your USP versus peers like Charlotte Hotels, Lemon Tree, Indian Hotels? And the part B to this question is, why did Hyatt Inc. Invest in Juniper Hotels when there are so many other players? So what's the USP that you're offering to them?
Sure, thank you. First of all, you need to understand Juniper Hotel is the owner and developer of large big box hotels. We like to own assets in big metros and tier 1 cities. And our goal is to have hotels which are in luxury segment. And these are hotels which would have multiple revenue streams. And our company is not in managing other people's properties or even our properties. We are very happy to have Hyatt come and operate our properties for a fee. And that gives us more leveraging and more focus on development and ownership. Our hotel assets are number 1, number 2 in every market that we operate in. And that's the segment that we will continue to focus on going forward. Whereas some of our peers would have their own brands and they would have some properties and some managed, we are a pure ownership and nurturing asset management company rather than having an operating arm. On our second part of the question, madam, if you may repeat that, please.
Sure. I'd want to understand why Hyatt Inc. has chosen to invest into the company.
Yes. This is actually our relationship with Hyatt started almost 45 years back when my father brought Hyatt into the country in 1982 with the opening of Hyatt Regency in Delhi. For next 15 years, from 82 to 87, we were owning and developing our properties and Hyatt used to be our management company. In 1998, I acquired the Bombay site, the Grand Hyatt site. And at that time, the Pritzker family, who is the owners of Hyatt globally and continue to own it now, were interested in investing in India. And they were very keen to invest with me. And that's how our new partnership was started at the Juniper level, where this platform was created with partnership with the Pritzker family and Sarafs. And that platform has grown from 1 hotel to now 7 properties. In 2009, Pritzker family took their own Hyatt International onto the listing platform of New York Stock Exchange. At that time, all the assets that were owned, hospitality assets that were owned by Pritzker family, were put into Hyatt platform. And that's how our Juniper landed up with Hyatt ownership. Traditionally, Hyatt or any of the global management companies do not invest in assets. They are more focused on managing assets and they are very fee-based. So it is a very, very unique proposition that Hyatt has held their shares, Pritzker family and then now Hyatt. For last 15 years, they have invested. And even with the IPO, none of the shareholders, Hyatt and the Sarafs, are selling any of their shares at this moment. Because we do see that there is a huge growth opportunity in this platform and we would like to stay invested and not divest at this moment or in the near considerable future.
Well, point well made there. But let's now actually dwell on more of the very essence of why you and I are here, which is fundraising, right? The company is raising funds for repayment, prepayment, redemption of certain outstanding borrowing availed by the company and its recent acquisition, namely CHPL and CHHPL. What's your leverage, your debt to EBITDA right now? With this issue, how much it will come down to and what is the level that you're comfortable with?
Yeah, let me start first. We are raising 1800 crore rupees of fresh equity. Out of this, 1500 is earmarked for reducing our debt, and 300 is kept with the company for general purpose, which basically means for growth. We are not short of money to run our company or in any way. So this 1500 crore rupees of leveraging, at present we have a leverage of about 2210 crores. Out of this, about 300 crore is promoter loans from our ECB, from our overseas ownership companies. And 1850 crore rupees, about 1910 crore rupees is the debt that is sitting out here with the different banks. So out of that 1900, we will be reducing 1500. So the company will, going forward, will have 400 crore rupees of debt. And our aim going into the future is to have a leveraging level which is going to be less than 1 times the EBITDA. Going forward, company may leverage up to slightly up to about 2, but that would depend on when the opportunities for new asset acquisitions will come in. So our big picture objective at this moment is to deleverage the company, and where we are now having almost 220 crore rupees of our profits are being deployed to debt service and interest payments. That will also become company's free cash flow going into the future post the IPO.
Okay, so debt to EBITDA, you said your comfort level would be 1, or rather it will come down by 1 post listing. Have I got that right? For FY25 is the number that you suggested?
Absolutely, madam. We are going to be less than 1 in terms of our EBITDA multiple for 25.
Okay, that will be the first half that we're looking at, or the second half?
First half, it will come down to less than 0.7. Okay, and depending on the opportunities that are coming up to us for new asset acquisition, it will depend on that when the new assets are being acquired. That's only when the company would re-leverage. Otherwise, we are quite sitting pretty with this leveraging at low level.
Okay, so 0.7 increases to 1, and then another year it can increase by 2. That's the long-term goal that you've set, right? For FY26, you can look at debt to EBITDA of 2 times, but that's stringent, or that's dependent on the kind of acquisitions that you made. Have I got that right? Have I got that right?
Yes, you got it right. Absolutely.
Okay.
You're right.
Okay, so help us understand which is this acquisition that you're talking about, because clearly the roadmap has been laid down straight. So is that within the listed space that you're looking at, not listed? Which geography are you targeting? How do you diversify? Tell us more about it.
Sure. Our real acquisition at this moment, that is real, is that hotels which are already there existing in the Saraf portfolio sitting outside this platform will be merged into this company and become bigger, subject to all the regulatory approvals and shareholder approvals as they may be required. So that would be the first stage of acquisition and conglomeration into Juniper platform of other 2 assets that are sitting outside this platform. Besides that, the next opportunity for growth is coming from Grand Hyatt Mumbai itself. In Grand Hyatt Mumbai, presently we have empty spaces and lands right next to our property, and we have 300 room additional capacity already approved by BMC and ready to take off. So those 300 rooms also will be added. So we are planning to have 1,000 rooms of additional capacity, additional rooms coming into this platform over the next 3 years period.
You said outside the portfolio also you're going to be consolidating. Could you dwell more on that? Help us understand what properties are we looking at, how many rooms, and when that can be completely consolidated and merged into the final entity. Could you help us understand this a little better?
Yes, we have in our DRHP a ROFO that has been built into that thing, and that ROFO basically is meant for Saraf Hotel, Arun Saraf controlled properties which are sitting outside the Juniper platform, where Hyatt and us we were not having ownership. And these hotels are basically in companies which are already listed on the stock exchange. So I am not going to dwell more. I cannot say more than that. But Arun Saraf controlled properties which are sitting outside this platform will be merged into it. And these are 2 Hyatt hotels sitting outside this platform at this moment. And through regulatory process, NCLT process, and shareholder approval and SEBI approvals as they are required, these assets will be merged. So this is basically our commitment to our new coming shareholders, that Arun Saraf and our Saraf families, this will become our flagship, and this is where we will continue to be focusing on our future growths.
Okay. Point well taken there. That's I would say that's an interesting bit there, but let's dwell on the financials now a little bit, because the company has been loss making for the last 3 financial years. Even for the last 6 months it has posted in losses. When can we expect a turnaround to take place, and what will be the drivers essentially? Sure, one part of it you would say that it's going to be coming in from the debt repayment essentially, which is going to be a bottom line adjustment. Beyond that, what are the drivers?
Okay, this company has been a profit-making company since inception. It is not something that at the property level, at the management, as a profitable hospitality business. It's the leveraging that has actually gone a bit, has taxed the profit and loss account, overly burdened the profit and loss account, and that's why we have seen the losses that are there. It has been healthy cash flow generating company, and the interest payments that have been, as I said earlier, of 220 crores, and earlier also they have dragged down the balance sheet in profit, the profit numbers in the past. Once the leveraging is corrected, you will see immediately a huge amount of all the savings of the interest that is happened, will flow into the bottom line of the company.
Furthermore, to add to that, right, so FY23 we closed at 717 crore rupees at a rate of almost 9,800 rupees average rate at 75% occupancy. Going forward, what will happen is these rates have already increased in the first 6 months. We're seeing 11,000 rupee rates. We believe that the industry growing at almost 12 to 15% will result in higher average rates. Also, with no supply coming into these larger markets, Delhi and Bombay contribute about 80% of our total business, and in both the cities, supply will be restrained. So, apart from the impact of the debt repayment, we believe the top line and the bottom line will correspondingly also grow going forward.
Okay, I was just looking at the financials a little more closer. Margins for that matter, FY21, the number is at 12%, FY22 it becomes 30%, FY23 it goes on to 45%, highest EBITDA per room amongst listed peers. A, help us understand a sustainable trend on the margin profile, that's one, and also B, what really explains rather your highest EBITDA per room as compared to other peers?
Sure. I think let's leave the 11-30% out for the time being. I think those were COVID phenomena. I think what has happened in 23, we've been able to go up almost to 45%. And going forward, I think the range of 45 to 48% is something we're comfortable with. This is the highest across the industry. Again, it comes because we have a diversified revenue stream. That's one. There's rooms, there's apartments, there's F&B, all contributing, and the combination of that is giving us these higher margins. But also we have an active asset management vertical within our company. So asset management, we define asset management as working with the operations team to increase our efficiencies. And this is what actually allows us to drive better numbers. So what is asset management? So within the Hyatt ecosystem, we have created a cluster. These clusters are across various departments, whether it's engineering, whether it be human resource procurement. What happens is because of the scale, we're able to drive certain costs and make it more efficient. For example, let's take manning. By looking at manning across all our various properties, making sure that retention can be increased. By actually making it more efficient by reducing manning and multi-utilizing the individuals across different properties. So these actually allow us to bring in certain efficiencies, and we believe that this is sustainable going forward as well.
Okay. Okay, I got the range 45 to 48%. The also follow up to this is, how do you think you'd be able to sustain that level? Because your expenses are pretty fixed in nature, right? 57% of your total revenue, if I've got that right. How do you intend to optimize that anytime soon that we can expect this?
Let me address that. Actually, hospitality industry is actually loaded with a very high fixed cost.
Right.
So this is something not only to us, but it will be across all the hospitality and all the hotels. This is the nature of fixed cost versus the variable cost. But this also is actually a great opportunity. You have to understand the fixed cost, 57% being the fixed cost at any of the hotel levels. Additional revenue that you generate which actually falls down to the bottom line. So contribution to the profit from additional sales is almost going up to 90%, in big cases even more. So you have anywhere between 80 to 90% of additional sales going into the profit bottom line straight away, because fixed cost by their very nature stay the fixed. So the growth, whatever additional revenues are coming, are exponentially helping you increase your profits. This is the nature of hospitality industry.
So that's not expected to come down anytime soon. That's how the industry works and will continue for you that way. There is no optimization that we can look at least on the fixed level.
Yeah, fixed level, these are fixed costs. So when you have a higher revenue, the fixed cost per component from the revenue will keep on coming down. But the fixed cost, which is basically being heat, light, power, and human resource cost, these are costs which are generally fixed in nature.
And just to add to that, so what post-COVID, we have actually been able to streamline those costs. Those costs have been brought under check. And we are confident that we'll be able to sustain that going forward as well. With occupancies picking up, with business coming back, there was an upward trajectory on that cost aspect. But keeping it consistent, actually, we've been able to ensure that the margins have actually grown and will continue to grow to a certain level.
Point well taken. Let's talk about the occupancy bit a little bit. 78% is the number that we're looking at for FY23 and the first half of the financial year. How do you intend to further inch that forward? What are the plans and the growth plans that you can again look at for in terms of the addition? So if you could reiterate that number for us.
Sure. So we're at about 78%. We believe that this will stabilize at about 82%, given the fact that we have large hotels. For example, Bombay has 547 keys. Delhi, Andaz has 401 keys. So at these large hotels, having occupancies at 80% is good. We believe these occupancy rates will be able to continue given the limited supply coming in as well. Having said that, the growth going forward, as mentioned, so there are two different aspects to it. There's the organic component and the inorganic. We discussed the inorganic component. The organic is we intend to add 300 rooms on the Grand Hyatt Bombay itself. We actually are going to build these 300 rooms. So this will add to our inventory in Bombay, and it would have a positive impact on our top line as well going forward.
Point well taken. Let's understand your revenue growth performance. 109% captured in FY23. I think that's straight up the recovery from COVID. So I'm not going to really take that in perspective because that's an anomaly of sorts. 5% is what you've registered in the first half of the financial year, ongoing financial year. What can be expected now on sustainable basis? What kind of trajectory can one look at?
You can look at a yearly trajectory growth in terms of average room rate growing by 10 to 12% at this from the present levels. So your growth that is going to be predominantly coming is from the average room rate growth, and our not only unique to us, the industry is actually looking at almost like 14% to 15% growth this year, and sustaining this at a level of about 10 to 12% going into the future. Looking at the supply scenario that is in our segment and in our market, there is going to be a huge unfulfilled demand growth, which is not going to be matched by supply. So you will see a continuous rise in average room rates.
Why do you say that? Why do you say that? What explains this exponential demand scenario that you're talking about?
Yes, India has actually, if you look at it, historically grown in demand about 10 to 12% over last 15 years. So this is not something that is unique. This is basically the shape of our economy and our growth of our economy. But the supply has been coming in tranches. So if you looked at from 2011 to 2016, mid-16, 17, for those 5 years, every city experienced a growth in supply of more than 100%. Some cities actually saw quadruplication of supply in all segments. So this supply, which was coming in tranches, if you look at Delhi, Aerocity added 5,000 rooms, keys to Delhi market. What would have happened to the demand? I mean, not the demand, but basically the rates and occupancy at these levels. So this is now all of the new supply that came in 2011 to 2016-17 has now been absorbed, and no new projects were launched from 2018, and very few of them are actually in the luxury and upper upscale segment. So in our segment, we do not see a huge amount of new supply coming in. To give you an example, if you look at Bombay, in Mumbai, there is going to be 2 incomplete hotels that have been sitting there for quite some time, will get completed. But there's no new supply in terms of launches in terms of luxury or upper upscale space has happened in those 4 or 5 years. And if anything gets launched now, also will take about 4 to 5 years to start coming into the market. So there is going to be a kind of a pause in supply. So the market in terms of the rates will move up and start catching up with the global rates that we have seen across the world, especially if you look at eastward from India. I mean, from Bangkok onwards to Japan and westward from Oman to Mediterranean. No market has a rate as low as India. I mean, we are looking at upper upscale and luxury segments, hotels being anywhere $300 plus in both these sides of the country. And in India, we are operating at 150 levels of average room rate in dollar terms. So there is a huge amount of growth opportunity here in average room rates going up. For all the hotels, I would not say unique to Juniper, but I would say the whole market will be growing. And obviously, if the market is growing, everybody, including Juniper, we are very well poised to grab that because of our segment and our positioning as number 1, number 2 in all the markets that we operate in. So this is going to be a very, very good times for hospitality industry, and the average room rates you will see steadily growing. And one more thing I would like to add here. Earlier, there was a kind of a resistance in the market at any rate between 14 to 15,000 in terms of average room rate. But we have seen over last 1.5 years that in the leisure segment, the rates have almost bounced upwards of 20,000 rupees a night. So there is a kind of what I call propensity to pay in terms of our luxury and upper upscale customers. So we are in a very good space on this revenue growth coming out by way of average room rate growths.
That sounds interesting, I must say. But your recently acquired entity, CHPL, which is now your wholly owned subsidiary, has also witnessed in delays in repayment of loans in the past and has accordingly undertaken strategic debt restructuring. What explains this? What can be expected going forward?
This was a platform where we had a debt of about 200 level, and the COVID times, all the hotel companies had experienced a bit of challenges in servicing their debt as per their earlier commitments. So this was a very natural affair where the company was able to restructure its debts with the existing lenders and has been on track for last more than a year now. Actually, it was done in 2022-23. Actually, so we are quite good in our space, and I think with the merger in Juniper and Chartered, this platform has grown, and these were 2 privately held companies with the shareholding of both the promoters, and it was very natural that before we went into the public, these companies were merged into one entity and making it a larger scale and size. So in terms of our debt profile at Chartered, this was a restructuring which is historical outcome of the COVID impact on the hospitality industry, actually.
Okay, so help us understand the revenue split between luxury, upscale, upper upscale. Could you give us a little split on that? Do you intend to change that anytime soon? And which of the following segment is more margin accretive?
Sure. So in the luxury segment, which is basically Delhi and Bombay, about 75 to 78% of our revenue comes from there. These hotels are sitting at almost 50% plus gross operating profit levels at the unit. The upper upscale, which is the Regency brand and the Hyatt brand, they are about 15% of our total revenue, and they sit at about 42 to 45% range. And the limited service, not limited, the upscale service, which is the Hyatt Place, that sits in about 40% bracket as well. So all the hotels are upwards of 40%, with the larger ones in the bigger cities driving most of the profitability.
Okay. Do you intend to change that mix anytime soon?
I think going forward, the idea is to keep focusing on the larger developments. That's our expertise, building large developments with multiple revenue streams. These projects are high capital investment and construction periods are also long. So I think we will continue on that, and wherever the opportunity presents for the upper upscale assets in emerging destinations, I think we will look at those as well selectively.
Okay. A significant portion of your revenue from operations, which is almost 91% for the 6 month ended September 30, 2023, is derived from 3 hotels, service apartments in Mumbai, Maharashtra and New Delhi, which is out of portfolio of 4 hotels serviced apartments. How do you intend to consolidate that? Because I think, sir, you gave us some roadmap that this is going to be, ultimately consolidated. How can now one look at it?
So the numbers that you see there, you would not see. So this Bombay Grand Hyatt Bombay, Delhi Hyatt Andaz, and the resident service apartment. So as you said, it's 90%. I think what is happening here is because of the chartered merger that happened only in the first half of the year. You're not seeing those numbers in with this. So if you actually see it at a consolidated level, that figure is not 90. It sits at about 78%. And between the apartments and the rooms, I think you have to sort of see that the rooms contribute almost 50 odd percent, and the apartments is a balance 15%. So that's how it adds up. I don't know if I answered your question, but because of the accounting sort of numbers, these numbers look a bit stray.
All right, gentlemen, that's all that we had for both of you. We're just gonna leave it at that and wish you all the luck for your initial public offering, which is hitting the primary markets on Feb 21st.
Thank you very much. Thank you very much. Thank you, Nickey.
All right, pleasure. All right, with this, it's a wrap. Interesting one. Debt profile comes down drastically after the listing. The company might just take more debt after the acquisition. FY25, they're comfortable with a number of debt to EBITDA of 1 time. FY26, that increases a tad bit. There is going to be a turnaround in terms of the profitability of the company, and the plans remain solid given the kind of EBITDA per room, which seems to be higher as compared to the other peers. But with this, it's a wrap on this edition. Thank you so much for tuning in.